You want to be a startup founder? It's 29 really hellish days and one good day. And it's those good days that keep you going. I knew that I wanted to start a business and that I was going to need to learn a lot before I could actually turn it into a ventures business. With these 9 companies that we invested in, there was no hope of them doing anything via token sale. So we had to say, all right, let's do something called building a product. And
that's a good one, right?
Totally. Novel idea. It starts with building. You need to know who you're building it for. And you need to have at least talked to them. Product, customer, investor. Looking at founders, I always look at them through the same lens, regardless of whatever their proposition is. Are they a good person? Are they ambitious? Do we have evidence of them going through brick walls? Do they have a big vision here? What is it that motivates them? Is it money, or is it just they have got this killer idea inside of them that they just really need to solve a problem? What else are they involved in? You see a CEO, founder of an early stage startup that you really like, then you go on the LinkedIn profile and you see they're doing 5 or 6 other companies. It's like, they're not going to focus. Who are their co-founders? How many are there? What are those relationships like with the co-founders? It's always team first. You don't really get it until you start writing checks and you feel that risk in the pit of your stomach. Okay, I just handed over 120 grand. It's all network, man. Learning, and it's getting to know people.
Welcome to the pod, Pete. I've been looking forward to this one. Our conversations are always amazing. So having an opportunity to gather some insights to share with audience, I'm really looking forward to the next 60 minutes. Or if we go a bit over, why not?
Yeah, why not? No. Thank you. I am so thrilled to be here on the show with you, Jesus, and that I really always am going to call you Jesus for the rest of my life. I know that some people call you Hesus. Yes. You pronounce sometimes your own name Hesus. Yes. But you will always be Jesus to me.
There's a funny story I told you around college. People say, "Hey, Zeus," and then the Jesus is caught on, right?
Yeah. No, it works. It works. So, but no, thank you again for inviting me on. I'm glad to be doing this with you.
I'm really looking forward to it, Pete. Just for people who don't know you, right? If you can just start with a quick background on yourself and how you ended up in Web3 and managing Techstars or Web3 accelerator, because I think it's been an incredible journey, right? There's a lot to unpack there, right? But pick up some critical moments for us.
Okay. Well, I was born a long time ago in a galaxy far, far away. Okay, that's where things start. Sometimes I feel like it. Living here in Ireland for the last 17 years, I do still feel like an alien from time to time. And but no, I was originally from outside of Boston. Grew up outside of the city of Boston in a city called Springfield, and so I didn't end up with the Boston accent of Pakanyaka and Fenway Park and all that. But it quickly becomes turned into things like when you move into the city, yesterday becomes yesterday and Saturday becomes Saturday. And before you know it, you're speaking like Good Will Hunting. Okay.
So it makes sense that you ended up in Ireland. There's big contingency of, Irish community down in Boston, right?
Oh yeah. I lived in Southie, and that's where Good Will Hunting took place. And that was in the, back 95 to 2000, I was living there, and Good Will Hunting was filmed right up the street from where I was living.
Oh,
and
nice.
we got to see some of that all happening. It was so cool. But there are parts of South Boston that you go into a pub, and if you speak like me, rather than speaking like some of our friends here in Dublin, Jesus, that you kind of get given the eye that, listen, this place isn't for you. Right?
Got you.
When you have the American accent rather than the Irish accent. So that was fantastic, because that was a key part of my life. Was I had gone to Galway on an exchange program in 1994, and I was raised through the Irish American heritage. That was important for me. I needed to get the hell out of Western Massachusetts, and I went and did that exchange program. But when I went back to the US in 95 to finish my degree and start working at Fidelity in Boston, kind of being part of that Irish culture in the US was really more important to me. And I started moving back and forth quite a bit, just on holidays, on various trips, going back to Ireland. And 95 to 2000, while I was right in the middle of having a great time and living in Boston, I was also back in Ireland a bit, and nearly went back in 2000 and moved to Dublin. And I was working with
good period.
Sorry?
Very good period to be in Dublin.
Oh yeah,
you know?
absolutely. But the money was terrible at the time. And so I said no thanks. And I ended up in Bermuda on a whim, met my wife there. She's Irish. And when it was time to leave Bermuda, that in end of 2005, it was like, let's give Ireland a shot. And I've been here ever since. But those, a couple points along the way, some really formative experiences when I was in Bermuda running a project, moving hedge funds off of one operating platform onto another operating platform. That was the most painful time of my career, in that, this was really intense, really complicated calculations around how hedge funds operated. It was nasty, nasty stuff. And I remember closing my eyes when I was trying to go to sleep at night after getting home from working a 14-hour day. And I would still see these spreadsheets in my head of all these different calculations. I would see it when I closed my eyes, like, the Matrix, these numbers falling in front of my face. It was ridiculous. But that really pointed out to me how manual the financial markets are. And it was absolutely a key critical moment, me doing this. And that when I jumped and moved into a role at BNP Paribas in 2006, that I was kind of brought on as, Pete knows everything about hedge funds. We need to get this business going. And it's like, well, it's still incredibly manual. And what you guys are actually doing for these really, really simple mutual funds is far more advanced than what was being done for operating hedge funds. And so it was a long journey. Those 10 years with BNP Paribas felt very itchy along the way in terms of my entrepreneurial spirit. They say that when you go to work for a corporate, you got to put your soul in a sock, right? You got to hide it there because all of these wonderful creative things that I'm doing now in working with startups, that all of that was kind of hidden for a while. And
it was emerging slowly.
Yeah. Yeah. And so that was 2006 to midway through 2016 that I was with BNP Paribas. But it was in 2014 that I had just closed a deal to acquire a business unit from a big bank that we folded into BNP Paribas. And I was meeting with one of the big clients of that business that was acquired, meeting with them in Paris, because we had brought them in for the Dog and Pony Show and wheeled out the big head of innovation. And the client was late because their flight was canceled or they had trouble getting to the office. And we had the head of innovation sitting there with his big 54-page deck, like, when are these people going to turn up so we can bring them through it? So I started flipping through the deck to kill some time. And I get to page 49. And there's the emerging tech page. And on it is a picture of Bitcoin. And this is 2014. So I knew what Bitcoin was at that point. But I hadn't really figured it out yet. And then below that, it was blockchain. And I said, what's that? Right. So in 2014, Google was quite helpful at me figuring that out. So I got back to Dublin from Paris the next day. And one of the first things I did was, what the hell is blockchain? And I found the Bitcoin white paper. And I got to page 2 of the Bitcoin white paper. And my jaw just dropped open. I'm like, and it was like all of my Christmases coming together at once. I said, if this simplistic, which I viewed it that way, this incredibly simplistic technology can actually work for this internet money, right? As we called it back then, and something that you bought a pizza with. Imagine if this technology can be deployed across the financial markets. And that's what got me most excited about it. And that was my route in, right? And I spent the next couple of years trying to figure out my situation as to how I was going to actually jump out. And in 2016, I did. And the idea was to get a venture fund launched and nearly did that 4 times. But that was definitely my entry point into crypto.
That's a fantastic story, Pete, because I same as well. Was a lot of talk around the Bitcoin and internet money. I really love the payments infrastructure that they painted. My entry point was actually in Ethereum, the Ethereum paper. So I was really hooked in the smart contracts.
Oh yeah,
I really love that piece. But also your journey then, you started West set up a fund to target this space. And then you ended up in Techstars now, right? Tell us the evolution around the ecosystem, what you've seen in the past years, where it's exciting as well moving forward, because I will say that's a hell of a journey as well, right?
It's all network, man. It's all network. Yeah. And when people talk about, oh, I'm going to go networking, sometimes there's this cheese factor to it, but it's not. It's learning.
People. Yeah,
it's learning and it's getting to know people. And I've always been a people person, as you might imagine. So I just, when I made the decision to jump, I had some help along the way. So Alan Meany and Des O'Donoghue from Fundrex, I went and had a lunch with them, and they kind of said, listen, you want to be a startup founder that it's 29 really hellish days and one good day every month. And it's those good days that keep you going for the next 29 hell days. And maybe you get 2 good days in a row, but that's really hard to do. And I knew that I wanted to start a business, and that I was going to need to learn a lot before I could actually turn it into a ventures business and launch a venture capital fund. That was the idea when I left BNP Paribas, was let's start a venture fund. And so, but I knew that I had to get some experience with just the way startups think and the way they operate. So I said, I've got some skills that I can contribute. I spent 10 years on the board of BNP Paribas in Dublin. I had some good ideas around board governance. I had, some good commercial relationships. I had some investor relationships that were not the right ones to start a fund with. And then I also had some local contacts in the startup community because I had started hanging out around Dogpatch Labs back in 2015 before I left. I met people like Mark Murphy from Finergo. I met, few other folks along the way that were helpful in getting me to think about this. And over the next few years, I kept looking for those opportunities to launch funds. First one nearly happened with a couple of folks here in Dublin, but there was a big investor in the fund that was going to be the anchor investor, and they pulled the plug probably a good 6 months into the relationship. So
process.
That one was dead. So went back to the drawing board, and in 2018, I think it was 2019, another opportunity came up, and that one didn't work out either. And I had tried to help a consultancy firm with their venture capital strategy, and then they decided not to do it. And then the fourth one was in late 2019, just before COVID. And fundraising would have started in January of 2020, and that was for a European-focused blockchain fund. And the fundraising didn't go anywhere because of COVID. So those 4 times, having gone through all those experience, I did so much reading on venture. I talked to so many VCs. I listened to so many podcasts. The best one I listened to was A Full Ratchet.
All right.
And, that was my master's in venture, and just learned as much as I could. But you don't really get it until you start doing it. You start writing checks, and you feel that risk in the pit of your stomach that, I just handed over 120 grand here. Right. And that's where you really get it. During that time, though, while I was also trying to get venture funds launched, I found ways to work with startups in what we call the mutually beneficial exchange of value. Sometimes that included cash. Sometimes that included equity. Sometimes that was just give first, right? And just help and see if I could learn something and make some new connections. And worked with probably about 25, 30 startups. One of them was in their Series E, so you wouldn't quite call them a startup at that point in time. And
Stripe still calls themselves a startup, so
of course, I know. And this one started with a coin and ended with a base. Okay. And so we
all can guess who it is, right?
Yeah, I was invited to join the board of their Irish subsidiary, and that was, it's been a wonderful experience in chairing that board. And then also, obviously, there have been some, brand halos that have helped from that. And it was 2021 when Techstars came along, and just through a few different people that were involved in a new accelerator program they were getting off the ground. They said, Pete, you want to run this program? And I jumped, and we, had a lot of discussions about how to make it work. And it just made so much sense because I by the time 2021 rolled around, the way that I was working with startups was say, listen, I will put you through a 10-week program to get you into fighting shape for funding. And we'll find a way for this mutually beneficial value exchange to happen. And let's just find a way to make it work if it was something that we both really wanted to do, myself and this founder CEO of the startup. And that putting that structure around things for the way I delivered value was helpful in being able to talk to Techstars about what it is that I would do and how I would do it.
Yes.
And was lucky enough to find Hugh McGurr, who was interested in moving home to Dublin. He had been up in Norway working for Techstars there, and brought him in, and then got the program going in 2022, made our first 9 investments we pulled the trigger and started the program just as the markets were dropping by 60% at the end of the last bull run.
No better time, right?
Exactly. Exactly.
If you can withstand that, you can withstand everything, right? It gives you the stripe straight away, right?
Yeah. It was quite a challenge. And the interesting thing was that you bring 9 companies in that you're investing in, all with the expectation that they would raise money via a token sale over the summer of 2022.
It was hot then.
Right. And when we were talking to them and recruiting these companies in, these projects in, as you call them in Web3, because they're not companies, they're projects, that we sincerely thought that things would keep going. And so that was the expectation. And the partner that we were working with at the time, that was their motivating factor as well, is that they wanted to invest in the tokens. But when the markets crashed and we realized there would be no token market in the summer of 2022, everyone had to, I say pivot, but it's not pivot their product, it's pivot their overall, pivot their funding strategy, their go-to-market strategy, everything. Because back in 2021, 2022, the rule of thumb was you went and raised, say 3, 4, 5, 10 million in a token sale, and then you'd spend a year building your product. Okay. Using that money you just raised. And then you're priming the pump of liquidity in your token and getting tokenomics to work. And you've got vesting schedules and cliffs and all this type of stuff to manage your token value, your token price in the market while you're building your product. You are not yet live. But with these 9 companies that we invested in, there was no hope of them doing anything via token sale. So we had to say, all right, let's do something called building a product. Right. And
that's a good one, right?
Yeah, totally. That novel idea. So let's build a product and get it into some customer hands and use those customer testimonials, whether they're B2B or B2C or B2B2C, and say, hey, Mrs. Investor, Mr. Investor, Mrs. VC, Mr. VC, look, we've got something here. We've got a product that people want. Let's get it funded. Let's get a pre-seed round put together for $750K to $1 million. And be able to then use that to build more product and get more customer traction, to get more investment in your seed round. So this is my flywheel, my startup flywheel, right? I've been working on the flywheel thesis, or flywheel concept for a long time with Owen Fitzgerald on the Money Never Sleeps podcast that he and I were doing, that I'm still doing. And that it's, hey, it starts with building. Okay.
Yes, 100%.
It starts 100%. With building. And you can't just build for nobody, right? So before you start building, you need to know who you're building it for, and you need to have at least talked to them. And when, say, people go talk to customers, they're like, well, they're not my customers yet. They're not paying you anything. It's like, well, they could be. They could be your customers. They're the person you're solving the problem for, or the business that you're solving the problem for. You need to have that material, that fodder that goes into how you build a product, right? And then build something.
There's so much to unpack there. That's why I knew this conversation was absolutely brilliant, Pete. So I was just taking a couple of notes there, and we're going to digress here big time as usual. Right? Sure. So I'll love first to unpack, because where you actually share some great insights there is around LP market, right? That market has evolved. You've seen the evolution of that market, right? Through the different cycles they went to raise the fund. And also then I want us to talk about, just so you just finish there, because I think it's very important and it gets lost a lot, is that validation period. A lot of people don't do the validation. They go and say, okay, this actually solves the problem for this particular customer, and they start building the initial, minimum viable product or minimum marketable product, as I like to think about it, right? But let's start with the LP market and then look at that part of validation, because that's a huge insight, right? It's a different way to operate.
It is. The LP market's crap right now. Yeah. Right.
But I'm sure you saw some good periods before.
there have been. there have been, but it's crazy, right? And then, I'm glad that I spent as long as I did in the hedge fund industry, talking to institutional investors and seeing how they allocate to different asset classes. Okay. And you take that general rule of thumb with a big institutional investor, a pension fund, say, all right, we got to put to work 500 million this year. Right. And look at the different asset classes that they're going to allocate across. And they'll have an economist on board that helps them with their investment strategy based on their view on where these different asset classes are going. And one of those asset classes is alternatives. Okay. Yes. And where usually that would account for somewhere between 10 and 20% of a institutional investor's allocation.
Yes.
And that alternatives allocation includes hedge funds, it includes private equity, it includes venture capital, it includes some infrastructure and debt and private credit and all these other types where you get more expected return for the risk that you're taking. Okay. And that helps to increase the overall return on your total portfolio. Okay. Because you're taking lower risk with bonds or with equities. That's a different discussion, and it's saying, let's try to pump up our risk. Pump up our returns, our expected returns here. What's happened now that interest rates have risen is that people are getting a lot nicer returns on their bond portfolio.
Exactly.
And so they're reallocating out of their alternative segment and into bonds and to other strategies because what used to be just kicking around in your bond portfolio of getting 1% to 2%, you're now at 5-6%. So that's making you think about your overall portfolio allocation a lot differently. And so venture is suffering. Venture capital is suffering right now in terms of the allocation of the big institutional investors. You're still going to find investors out there. An emerging fund, first time raise, you're not going after those big institutional investors anyway.
That's what I want to center as well. And so that's one of the anchor there, Pete, because for first time fund manager, right, and raising in the Web3 area, right, Web3 or call it DeFi, different names, crypto that have been bounced around. I think the experience potentially could be different as well because some teams are more established, like fintech, for example, right? What have you seen in that particular space when you're trying to explain to them this ecosystem and the potential within the ecosystem?
Yeah, I mean, we're at a stage with crypto, right? And that when I talk about Web3, I use the Sam Williams definition, which is the protocolization of web services. And where you can take an activity that a company used to do on the internet and you can turn that into a protocol. And a protocol is a set of rules that are controlled by computers and that where you can trust the code to deliver the expectation, okay? So the biggest component of Web3, when you think about protocols right now, are crypto protocols or blockchain protocols, where you've got 1 trillion in market cap right now in crypto assets. And that is the biggest component of Web3 right now. There are other components, obviously included in the crypto market cap is the market cap of DeFi.
Yes.
And there's total value locked, which is a different thing altogether.
Yes.
You've got non-fungible tokens that have been launched out on the market that are related to communities and brands, and big brands like anything from the Bored Ape Yacht Club to CryptoPunks to, well, look at what Nike and Adidas are doing with NFTs and creating some value around that. And, a few hundred million of value that they've built around that. Okay. So all of those things together are governed by protocols, and the movement of value around the world on blockchains is governed by protocols. So Web3 is the overall umbrella for that. And some people look at it a little bit differently, but that's how I describe it.
I agree with that as well. Is the basket, is the overall basket, right?
It is.
Yeah.
And what's happened in the last few years is that it's been clearly recognized coming out of the bull run that we had in 2019, 2020, 21, 22. And, the bull run more in 2021 and 2022, that there are lots of holes in the Web3 ecosystem, and that one of the biggest ones is that the being able to onboard everyday users into blockchain protocols and being able to make sense of them, to be able to get value out of them to be able to use these products.
Yes.
And probably one of the best examples are stablecoins, which are crypto assets that are pegged to the US dollar primarily. And being able to use those to move money around the world instantaneously, particularly in economies where it's incredibly high inflation.
Yes.
And so take Argentina probably is a great example of that. And that what we're seeing is that the on-ramps and off-ramps to be able to do something like that, to be able to go into a market like Argentina and say, hey, we've got this app that lets you move USD around the world to pay for things, to be able to receive payments, and that it's a lot easier right now to trust the US dollar than it is to trust the Argentinian peso. So let's make it easy for people to do that. And that's one of the things that isn't really recognized out there right now in the web. When folks outside of crypto look at this space, they're not seeing things like this because they're not big enough yet. You know?
And that's the part that got me really excited about the DeFi space, to be honest, Pete, is that developer markets and how this could be actually very transformational in developer markets. Some of them might leapfrog as well with this opportunity, right? And you're right. There's a big problem there. We don't see the problem here, right? So it's not a problem for us in this part of the world we live, right? We don't worry about, now our money is not worth anything. Right. In the morning, I've been saving like for 10 years, and all of a sudden, poof, it goes. Right.
There's 1.6 billion people in the world who are unbanked. Okay.
And that too, right? We all have bank accounts, and we're able to do the AML, KYCs, etc. So people, they don't have those basic services, right? That we take for granted here. And this is a very, very good segue, because for me, I think that user experience. Now the industry has evolved, start to understand in order for these products to be adopted, the user experience is key, right? What are your views there as well, Pete? Because I think the industry itself went on the journey of the user experience because they will build it for themselves, I think, initially.
They will. We need more investment in this space, which will drive it. And I would like to see that there's a few kind of macroeconomic winds that are blowing in the right direction for us in Web3 and in crypto that will hopefully generate some more capital flows and investment into this space over the coming 3 to 5 years. But the way to think about this is that in crypto, the biggest thing is security. It's being able to say that, yes, my crypto tokens, my crypto assets are safe, whether that's Bitcoin, whether that's ETH, whether that's USDC or Tether, the two biggest stable coins.
Yes.
And that there are being able to make sure that those are safely held, whether that be through a centralized exchange like a Coinbase, whether that be through a wallet, a non-custodial wallet as they're called, and I won't get into that, such as MetaMask or the Coinbase have their own non-custodial wallet, or you're holding it offline in what's called a hardware wallet, like a Ledger Nano.
Yes.
And that is the most important thing, is to make sure that it's safely held. Okay. What has lagged behind is the usability.
Yes.
And so where we need this to go in the whole industry is bringing that usability up times 10 from where it is right now. Because even me still, when I'm messing around and moving assets around from wallet to wallet, it's easy to get lost in the complexity of this. You got to check yourself to make sure you're doing everything right. And so that's where I'd like to see a lot of the investment go. I invested in a company called Trustware through Techstars that are focusing on just that. And it's very easy to remember their three key things because they're one of the American companies that I invested in, the USA. And the three things are USA: usability, security, and accessibility.
Oh, that's nice.
Right. And so very, nice. Very easy to remember. So thank you, and shout out to Jesse Phillips for pulling that together for me, and Jonathan Frazier as well. So that's where we need to see the investment. And if the good analogy for this is to say all of the engineering has been the same team that has developed the security as well as the UX.
That's the challenge.
Just imagine like a Tesla, okay? A very highly engineered battery system in order to run that electric motor and be able to optimize the power sharing around the vehicle itself. And imagine the same engineer who designed all of that also designed the cockpit. So the ergonomic steering wheel, the dashboard, the whole user experience. And that's where we are with crypto right now, is that you don't have the beautiful Tesla for how people engage with their vehicle, right? What you have is this kind of clunky combination of stuff that, where I just went through 3 examples of stuff that people generally aren't going to understand. Okay, there's a centralized exchange, and then there's decentralized exchange. Then there's custodial wallets and non-custodial wallets. And then there's hardware wallets, and then there's cold storage and this air gap thing. Okay? If you have to talk about that stuff to people when you're telling them about a way to manage their financial lives, it goes right over their head. Forget about it. Right? So we have a lot of work to do there. I'm expecting, and my big bet is really on the spot Bitcoin ETF, which is an exchange traded fund that would hold only Bitcoin, and that the institutional investor, like we talked about before, that is looking at all asset classes, a number of them have identified crypto as a important asset class, and that they will start allocating. And when you got a $500 million fund that is allocating 1% of its capital to crypto, right? That's 5 million. And you do that 100 times over, you get another, 500 million into that. Okay. And it starts to grow and grow and grow. And that could be the next big push into crypto. And it's not just going to be the Bitcoin ETF, hopefully, that gets approved by the SEC, hopefully sometime this month, fingers crossed. They could kick it back another 45 days, but Ethereum ETF.
Exactly.
And then you're going to see all of these impacts happening because there's this process called staking of crypto that you can do, in where you lock up your asset on a network and you get paid an annual percentage yield on that back in that crypto. And that is as a reward for taking that risk, as a reward for locking that up into the network. And that happens with Ethereum and a bunch of other crypto assets, but it doesn't happen with Bitcoin. So this could unlock, if we get this big flow of institutional capital into Ethereum, we could end up with a significant growth wave that's happening here.
And that's what really got me excited about DeFi. Peter, we talked about this in numerous times. I do believe that the ETFs, probably both of us were bullish on this, that the ETF is going to happen for Bitcoin and Ethereum. And of course, the others, obvious, the onion swaps, etc., will follow, right? And that DeFi space, the staking, could be very exciting for anyone that really believes in this area.
Oh yeah, we know Amora Sexton here in Dublin from Block Damon, and she is the head of operations for that business. Sorry, she is the head of international operations now, I think, and she's doing really well there. And they have the staking solutions for institutions. And also spoke with Eva Lawrence from Figment last week on the podcast, and has a lot of those same things, or had a leading provider there as well. So for both of them, that this could unlock quite a big flow of capital into the industry.
And the industry needs as well to see that institutional investment coming in a big way, right? And I have my fingers, my toes crossed for this, but I think it's going to happen. I'm positively optimistic on this for a while, because it's just obvious. Is that obvious, right? We just have to get through a couple of hurdles, structural hurdles.
But there's a danger. There's a bit of danger in this.
It's risk allocation, right? At the end of the day, it's not going to be a low risk asset class, right?
The danger at the micro level, obviously there's always, and again, none of this is investment advice.
Caveat that.
Right, or legal or tax advice. But you're always going to have that in a new asset class. You're going to have speculation. You're going to have some toxic activity. You're going to have bad people out there, right? So you're always going to have some scams, and there's tons of them out there. Out of the top 10 crypto assets, that is 0.1% of the crypto assets out there in the world. And that's where 95% of the value is in the top 1% of crypto assets in the world. Bitcoin, Ethereum, 2 stable coins, and then 6 other crypto asset tokens. Okay. That's the top 10. One of them is a joke called Dogecoin. All right. So, but I'm not going to go there.
Shout to Elon Musk next.
Yeah. But you're always going to have that. But the micro risk really at the startup level is that notion of, hey, this is the way it's all going. It's going to happen. And of course, this way of doing things is so much smarter than the old way. And people just need to realize this, and they just need to see the light. If you go in with that mindset, you're not going to sell anything, right?
No, I think
you're not going to sell meat to a dog on a meat truck. Okay.
Not at all. Not at all.
So it's the approach. You still need to push the founder. What problem are you solving? Who are you selling it to? And get it into that mindset, or else you won't get anywhere in the space.
Totally
in any
agree,
space.
Because the ones that go into an ETF are the mature ones that we spoke about, right? So at those ones, it makes sense for an institutional investor to go and actually start putting them in their portfolio. But coming back, and I love you talked about now low figures in dollars, right? Because before the projects would be like, I need to raise 5 million, 10 million, 20 million. We saw some crazy things happening in the market. But now, as you said, you grounded them back into the foundations of the initial 750K to $1 million to actually build the initial minimum marketable product, right? That's a huge reset for the industry to go and build a new validation as well, right? How are the founders now responding to this?
Well, one of the biggest things is just getting founders to understand there's a difference between your pre-seed round and your seed round. And in, let's just call it Web 2, that you shouldn't be raising a seed round or signaling to the market or talking to investors about a seed round until you have somewhere in the region of $30,000 in monthly recurring revenue.
Yes.
Okay.
Part of the market fit.
Ideally, you're at 50, and that is where you are for your seed round. And when you're pre-seed, that is, you're generally zero revenue, or maybe a little bit, maybe $1,000 a month. And that you are just pushing on the verge of getting your product out there. It's not idea stage. It is not idea stage. You are well progressed at the point where you're pre-seed. And at pre-seed level, you're still only a 2, 3, 4 people max. But in order to get to the next level, which is what the VC wants you to do, say they write you that check, or a number of VCs write you that check to get you up to $1 million, say, for your pre-seed. The worst thing you can do is just spend that money and then not get to your next round. So there's a vested interest for those VCs to help you get to your seed round, but you need to hit your milestones. And for you to hit those milestones, you've got to have the right team in place, maybe get a couple more hires, but you're not going to be able to spend a whole heck of a lot of money that quickly, because there's generally, people want to see no more than a year to 18 months between your pre-seed or your seed round. If you can't progress to the next round quick enough, that means you're not moving fast enough. You're not building fast enough. You're not making enough progress. And so it's a very, very tight time frame. And that's why a pre-seed round is a smaller amount of money, because it's just not possible to spend that much money that quickly in the time that you need in order to show your investors that, yes, we can make the progress. We can get to our seed round. We're going to say raise 5 million or 6, 7, 8 million in the seed round. Back in the day of companies raising 14, 15, 20, 25, 30 million in their seed, where that was Web3, and that was all being done by a token sale. And where you'd have some crypto VCs that would come in, or crypto hedge funds that would come in, and they'd write checks of $1 million or 2 or 3 million. And you would get this huge amount of retail market interest on this. And that you were basically just selling to the public your tokens, or your when issued is effectively what it was, to put it into traditional financial parlance, that said, when this token is issued, you're going to receive this allocation, at your token generation event. And those days are gone, because the markets just aren't there anymore, because everyone else has moved on to other things. And so it's really bringing it back to, where are you right now? Where's your team? What are you good at? What are your relationships with the market that you're going after? What are you going to sell them? How long is it going to take you to build it? How long is it going to be until after you build it, you can actually get it into users' hands and start generating some revenue off that? One of the biggest things with Web3 is that sometimes it's not just generating revenue, it's showing that you're creating value and that there's value in your network. And maybe you have launched a token. Maybe you need that token because you are truly becoming decentralized. And that token is a representation of the value you built. That is your economy. You built this token economy. And so it's not always open and shut. And I was talking to a crypto VC just last week or 2 weeks ago that said they look at it differently, right? The pre-seed, seed, and Series A. They've invested in Series A Web3 projects where there's no revenue, because they can see they're creating value, because their token is out there live in the market. Yes. There's a market cap on that token of a couple $100 million. And that is like post bull run. That is in the middle of a bear market where they're seeing that happen. And that all that they classify these rounds is, well, pre-seed is your first round, seed is your second round, Series A is your third round. In Web 2, you need to show the revenue traction and the customer traction throughout each one. A well-established and intelligent crypto VC can look and see, I can see the technological progress this team is making with building the network. I can see the number of users. I can see the size of their community. I can see all that. And I'm comfortable writing the next check at a smart valuation to be able to get them to the next level. And some of the time that just involves token supply, and that doesn't involve equity at all. So there's, you got to be able to see both sides of this. You got to be able to see the Web 2 kind of view and the Web 3 view to really cut through some of the crap here.
100%, Pete, because of course, we started with the digital area of fintech, which is like predominantly Web 2, right? And do those mechanics, revenue, build your first product, generate more revenue, enterprise products. Then you go and get your Series A, and you go for a global takeover.
Yeah,
in a way, right? But those dynamics were not being played out in Web 3. But it's nice to now see those dynamics played out in Web 3 as well, where you have to really understand the problem, solve a problem, build value, right? Because even you mentioned it initially, right? The network effect, the ability to go out there and talk to the market, Pete, right?
Mm-hmm.
They have to do that by nature, right? So that's how you learn about your product. They do that customer discovery, right? And also, I would like to understand now what you look at in operators, Pete, right? So when you're really selecting operators, what are some characteristics that you like to, see that you can define, okay, this person actually can go and rationalize all the stages and potentially succeed, right?
I mean, my favorite kind of people are those that don't lie. Okay.
Yeah, you have to be direct. Like it's a hard journey. Just say it as it is.
There's a lot of leftover fluff from the crypto bull run of people just thinking, hey, someone's going to throw money at me at some point. All I got to do is just keep speaking the bullshit, whatever. Right. Mm-hmm. So, this looking at founders, I always look at them through the same lens, regardless of whatever their proposition is. Are they a good person? Can you find some reference points for that in the way they talk, the way they make eye contact with you or not, the way that they may, and obviously, there are some folks that generally do not like to make eye contact because of just their own chemistry. And that is something that you have to be aware of, because that can be a positive or can be something that you would not want to see. So there's lots of little mechanics there for figuring out if someone is a good person or not. Obviously, the best thing to do is talk to someone who knows them. And you can do that through a LinkedIn profile. It's easy enough. But are they experienced? Do they have deep firsthand experience of the problem they're solving? Are they ambitious? Do we have evidence of them going through brick walls? Do they have a big vision here? What is it that motivates them? Is it money, or is it just they have got this killer idea inside of them that they just really need to solve a problem? They really need to solve this specific problem because it's been eating away at them for so long. And can you get to the bottom of that? What else are they involved in? LinkedIn profile gives away so much. If you see a CEO, founder of an early stage startup that you really like, but you go on the LinkedIn profile and you see they're doing 5 or 6 other companies, it's like they're not going to focus, right? What's their academic background? Had that been something where it was perhaps too much academic and that not enough true business experience? Sometimes that's good. Sometimes it's not good. And that, you may have a very incredibly smart, intelligent, driven person that just may not be able to get customers on board. And they will get there. It's just, they're going to need a lot of coaching. So it's always team first. It's always, and team, big word. Who are their co-founders? How many are there? That's another big thing. Ideally, it's around 2 or 3 co-founders at max when you're at the earliest stages, but sometimes there are more, and that can be okay, or it might not be okay. And what are those relationships like with the co-founders? Have they worked together before? Can you notice any static between them? Zoom is great for that, because they think you're looking at one founder, but you're looking at the other founder while the other one talks.
Yes.
And you can see their facial reactions to all that and how they feel about what that person is saying. And if they roll their eyes, that's a dead giveaway. If they talk over each other, and or if and it's like where one person starts talking and someone else doesn't like it and they take over and just don't even say, oh, can I actually address this? Do you mind if I address this question? It's just they just start talking over them. That's not a good sign. So we test for all of these things, and the homework is always a good way to do it. If you give them an assignment and see how quickly they come back and have they done it right. There's founders still that that I know incredibly well that some of the most basic stuff they don't have down yet. And are they good listeners? Are they actually going to pay attention to what you say? Because that's the worst thing when you spend so much time, when you spend 13 weeks in an accelerator program, trying to share this knowledge with founders, either yourself or through others in your network that you bring in as mentors. And then you have people that don't listen. It's like, why did I even waste my time back 13 weeks ago having you in the room with me if you weren't going to listen? People get distracted. They miss things. That's fine. Other situations come up, but you can really tell the difference between those that pay attention and those that don't. And it's,
I love you mentioned that coachability element, right? Because in this game, you have to be able to learn and unlearn things very fast, right? To be willing to just say, I was wrong, right? Now my hypothesis is being proven wrong, and move the hypothesis to something else, right?
Oh, yeah.
Listen to the customer. You mentioned as well the Bored Apes. And when the Bored Apes executed their strategy, I thought it was beautiful. From a strategist, I was like, this is absolutely amazing. And they were able to connect the digital world to the physical world, which I thought was really, really smart. And I think the industry could have thought like that from the start to get-go, because this has to come as well and impact real world assets in a way, right? And bring the community offline as well, right?
Oh, absolutely.
What are your views around that area, Pete? Because those guys really executed masterfully.
First, quickly on coachability and mentorability, that is absolutely critical. So we test for that significantly, and we put prospective founders in front of other folks that say, can you test them for mentorability? And there are, again, dead signs there as well, is that if you're going to invest in somebody, you need to know they're going to at least think about the advice you're giving them and say they will go down this path. In terms of Bored Apes, it's quite a story, in that, hey, how are we going to get something to market that people want to buy? And they do it in the middle of this crypto bull run and, wild speculation around it. And I've talked to a couple of people around this that said, well, they then moved on. Not that they moved on, but it looked like the natural evolution was, hey, we've got this community now. Let's start getting people to feel like they're part of this tribe. Yes. And giving them some of these benefits, the utility of the tokens. And some of that was, well, if you've got a Bored Ape Yacht Club NFT and you show that, you can actually get into a real life yacht club, in Miami. And so getting, like you said, this connection between the digital world to the physical world, and that where you've got meetups and people are all part of this club. And the folks that I've spoken with said they didn't do that on purpose. They kind of fell into that because it was
you just ruined it for me. You just ruined it for me.
Now,
there was a strategic move, right?
This person who shared this with me, and she knows who she is. She said she looks at Bored Ape and she's like, whatever. That is such a toxic bro culture. She wants nothing to do with, right? So because she had such an insider view on this, I asked her about it. And she said,
if you're impartial, you just look at what they did.
No, and that's it. But I mean, there is a NFT 1.0, NFT 2.0, NFT 3.0 journey that we've been on. And the first one was CryptoKitties, CryptoPunks, the beginnings of Bored Apes, where it's just like, these are JPEGs. People are buying JPEGs. And you got enough people interested in this, then you're going to get the buyers and sellers and buyers and sellers and buyers and sellers, and prices go up. Okay. And then so NFT 1.0 is just buying pictures of stuff. Okay. NFT 2.0 was that you started to get this community feeling to it, or you did get this community feeling around it, is that it was a membership card. All right. And that brings specific benefits, whether that's having access to people for conversations, whether that's being able to get into a real yacht club, whether it's getting to any other kind of exclusive real world clubs, but it's still very exclusive and it's still very bro culture. NFT 3.0 is that where you start using these kind of in a more kind of obvious way for real world use cases, such as if you buy this NFT of, say, this, let's say so if Tribe Called Quest, one of my favorite hip hop groups from the 90s, if they ever issued
Q-tip.
Exactly. And if they ever issued NFTs, I'd be the first one to buy. And what I would want is that if I buy that NFT, I want to get the early access to buy tickets for the gig when they come through Dublin. And if I can go onto the website, whether it's Live Nation or Ticketmaster or whatever, and I can authenticate myself with my crypto wallet, showing that I hold one of these Tribe Called Quest NFTs, that means that I do get access to the presale and I can get inside to the front row seats. And I get access to that because I hold the NFT. All right. Now that is NFT 3.0, which is
and that's a sale for the consumer, right? Pete, right? That's how really you bring the retail on board, right? So how far do you think that we actually, I guess there's some players that made some big moves in the market with tokenization, Pete, right? So it's getting closer and closer to that, right?
It is. Well, I mean, we're already there with that example I gave. It's not Tribe Called Quest. It's some rock band whose name I forget.
Mass market.
In the US, and it's there. And I think it might have been Live Nation that did this.
All right.
And so it's happening. But the success of it is very much geared right now towards the fact that it's tiny. It's tiny little proof points, small wins that are happening. For that to become totally scalable, it can't be dependent on, all right, here's what I had to do when I did buy a ticket as a token to go to an event. I bought it using my MetaMask wallet that I connected to the website of this ticket seller. And then in order to get that picture to show up in my wallet, I had to go into something called Etherscan, and I had to copy and paste out a contract ID out of Etherscan into my wallet along with a token ID in order to get that image to appear in my wallet, because the link was broken. And I'll leave it at that. So that I could then show my MetaMask wallet with this picture at the door so I could get into the gig and get my little wristband to get a free pint. Okay. And that was the benefit. So if that experience if that experience continues for others like me, it's only going to be crypto natives, and only going to be crypto natives that can copy and paste on their phone that can go to these gigs.
I couldn't agree with you more. I think user experience really has to be taught in this space. That's what I kind of say for the retail, the mass adoption. Gary Vee is doing some interesting things there as well in that space, because imagine if you go to a concert and all of a sudden the concert ends and you're like, I'm going to bring top 50 people backstage, just have a bit of fun, and they connect with that NFT, and that's how you actually in real time, bring those 50 people behind doors, right? I think there's incredible journey to be had there. I won't do a guest. I want to ask you something, right? Because for our guests here, they know it's about mental models, right? Tell me some frameworks, some mental models you used in the past, Pete. You talked a bit about the Flywheel one, right? You yourself and Owen developed, but you can talk about that one, or you can give others as well that you feel that would be valuable.
Yeah, I mean, I've got a bunch that I use as kind of little mnemonic devices. The Flywheel one, there's no mnemonic device. I don't need to use a mnemonic device to spell out the word flywheel, because I'm always going to remember it. And the classic Disney Flywheel is the example of, you watch a Disney movie, you get excited about the movie, you realize there's a theme park where you could go perhaps experience some of that movie. And so you go to the theme park. At the theme park, you love the experience so much, so you buy some merch. When you buy the merch, you take it home, it reminds you of the movie, and you want to watch the movie again. You watch the movie, you want to go to the theme park. Flywheel, it spins around and around. There's one, and it's the revenue point at each stop on the flywheel, and it gets this momentum building. And Disney have been relying on this for 50, 60, 70 years, however. Yes. There's an Amazon flywheel that has been the subject of books. And I won't get into the explanation of that one because I usually stumble through it. But having been a student of all these made me realize this flywheel of startups, which, as we were talking about before, you get your basic part of your product built and you get that into customers' hands, product to customers. And then once you have those customers, you can use that evidence, that conviction that you have that you are solving a problem for somebody, to pull together your story and into a pitch. And you take that customer feeling and you put that into your investor pitch and you raise some money. Now it's oversimplified. Okay. So product, customer, investor, product, customer, investor. You take that money that you raise and you build more product, and you build out that product further in order to get more customers. You use that evidence and more customers to go raise some more money. You take the money that you raise and you build out your product further. That is my flywheel. And there's one that I draw out that works to explain that point of moving from your pre-seed to your seed to your Series A. And it's really driving that home that these are cycles that are run for startups and how they get funded. And there's risk on, there's risk off at different points of the journey. The one that I use for accelerator models is that it's all about time, TIME. Okay. And
I love a good acronym. I'm looking forward to this one now.
Yes. So if you want to be successful in an accelerator, the first T is for team. Okay. And that it can't just be a founder that comes into an accelerator program. You need to bring others with you, and you need to pay attention, obviously, but you need the opportunity to learn and experience that needs to be shared, because the founder, the CEO will learn a lot of stuff, but you need others to be on board as well. The team concept also applies across. It's not just you and your company. It's the other companies that you're doing this accelerator program with. You become a team. This is a best support group you're ever going to have as a founder, is those other founders that you're going through this program with. But finally, also that accountability that my team builds, myself and Hugh McGurr, builds with all of the startups together and the other people that we bring in to help out on the program. Okay. And having that accountability and structure is critically important. So that's the first one, T. The I is for investors. We need investors involved in this program, and you need them involved at the beginning. And so that they get a look at the companies as they're coming in and understand which ones they like, which would be right for them, and those that wouldn't be right for them. And you want to keep them close and you want to keep them engaged. We work with a network of about 300 investors in my program, and we get 10, 12, 15 involved at the earliest stages to help kick the tires before we actually select companies, but then also to have an early look and see how they're doing with developing pitch decks and give them some feedback on that from an investor perspective. And maybe there'll be a first check that they would write. But it's critical to have those investors and involved in the middle of the program when we're, perhaps doing some initial investor integration, and then at the end of the program, absolutely, to get those investor relationships kicked off. So you absolutely need the I. The M is for mentors. We run this as a mentorship-led program. You need to have what typically happens during our Mentor Madness period is that you've got startups that will go through and talk to 75 mentors and tell them about their business, and you get people split into two camps. Either you come through those 75 conversations, not 75, usually probably 60 that you would go through, and you'd end up either, hey, we've confirmed all our assumptions, or most of them, and we're going in the right direction, or hey, nobody got that. This is terrible. We need to pivot. And I just talked to one of those companies in another Techstars program yesterday who are pivoting, and it's a brilliant pivot. And they got that from going through Mentor Madness. And that people said, this is not the right problem for you guys to be solving based upon your team and your expertise. And so having those mentoring relationships all the way through the program that then they can carry forward into their next stage of their life as a company or a project is critically important. The final E in time, education. People need to learn. And I had a founder say to me just yesterday, we learned so much in that program.
I love that education piece as well. I think you have to be constantly learning, right?
There's so many things that startup founders don't know that, Jesus, from your experience as a founder and everything that you've been through since then, that right? That are just completely foreign to other folks that are founding a company for the first time, or just they're very new into that. And there's Startup 101. There's so many Web3 perspectives out there on crypto, just the way that investors think, and so many things that you can do that you can teach founders that will may not always be the best, perhaps. Wow, oh my God, if I do that, I'm going to go 10x. It's that don't make this mistake. That's it. And because you're going to save time. You will save time if you're not making that many mistakes. So team, investors, mentors, educators, 4 critical parts of running any accelerator program. A few years ago, a company was talking to me about running an accelerator program. I'm like, oh yeah, I'd love to do that. I'm like, well, how would you do it? And I made up some agenda. I didn't obviously end up running that accelerator program. So now, having been through it a couple times, I've got a much better appreciation for it. You can take that thing, that time, and you can apply that to each stage of a company's journey. And when you're at the pre-seed level, it's about forming the team. It's about starting to engage with investors. It's making sure that you are not just talking to a vacuum. You need to talk to people who could help you. You need to talk to your mentors, and you need to be learning all the time.
Big time.
And
Big
then
time.
when you move to the next stage, that balance between those different activities shifts. Okay. So we have a very short time on this planet, and that's why I like to focus on that.
And Pete, I know this conversation will go in past the time we had allocated, right? And I'll go quickly into some fireside, quick fire chats, kind of rapid fire in a way, right? One of them is growth tactics, right? What are growth tactics you've seen in the past will surprise you, and probably 1 or 2 that you want to share here with the audience.
Talk to customers every day.
Yeah, just go for customer.
That's it.
Discovery.
Talk to customers every day. No matter what you put out there in terms of a product and getting that into people's hands, that you need to understand how they're using it, what they're doing. And you can do so much with analytics, but you've got to talk to customers and get their perspective every single day. And
if I was going to ask you, and yeah, I know you shared some at the start, but a very key pivotal moment, right? You had a challenge, you turned into an opportunity, right? What would be another one that you like to share?
Yeah. So I might have said before it was 2019, but it was 2018. And was it 2018? What was happening in 2018? I had finished with that. No, sorry, it was 2019. So this was the 3rd venture fund that I was trying to get launched, and worked on it a couple days a week with a group of people. And for a period of 6 months, worked on it maybe 3 days a week for 6 months with no inflows at all, 0 inflows. And that would have started in February of 2019. And then by August of 2019, I realized this isn't going to work. I went and had a 15 to 20 minute conversation with the 2 other guys. And I said, guys, I just can't do this anymore. It's just not working. We're not going to be able to hit the mark on this. I've got to step away. And that was soul destroying because I had put so much into that. I thought that was going to be the one. I really thought that was going to be the one of getting a venture fund launched. And it wasn't. And I took a day or 2 and I said, you know what? I've got all of these different opportunities, not even opportunities, but things screaming at me that I need to do and pursue. I just let it all drop to the floor. I let all of it drop to the floor. And I only picked up those things that were screaming at me. Okay. And only picked up those things that I thought would be really big opportunities to pursue and that I thought were going to be worth doing. And so that was kind of my lesson learned. When you've got everything crashing down on you, let it drop.
Let it drop.
Let it drop for a day or 2. Take stock and say, all right, 100 things just fell to the floor. I'm only going to pick up what I can carry with 2 hands. That's it.
Oh, that's beautiful. I love that. Another one, Pete, for me, I would like your perspective because you talk a lot the ecosystem, you embedded in it. We're now going through a good moment. There's some regulation coming through. There's some good institutional, investors and also social players really doing some great things, right, in the space of Web3 and crypto. What is your view for Europe and globally as well, if you want to touch on US and other parts of the world, next 3 to 5 years? Where is exciting you at the minute, right? And where you think it's all going to go?
It's like, yeah, you say you're a geek in this space when you say you're excited about regulation, but I am.
Yeah.
I feel like regulation's kind of my superpower in that I can look across 3 different regulatory regimes and see how do we build one operating model that ticks the boxes
Yes.
for all of them at the same time, right? That is true regulatory arbitrage, right? Not the kind of trying to pick the one that will be the least intrusive and least heavy on you as a business. It's saying how can we
don't
more?
go there.
So I'm very excited about the market and crypto assets regulation that's coming in. We finally have some rules in a major world jurisdiction that is 500 million people in that jurisdiction,
Yes.
which is big, about even just defining what a crypto asset is and defining 3 different strands of them that are then covered by the first wave of this regulation. And there will be more, and that we're going to see that go into play in 2024. And what that will do, it levels the playing field, but also gives the big opportunity for those in the US and in Asia that are frustrated by a lack of regulation and that they're not seeing the clear rules for what they can and can't do, and that they come set up here.
Yes.
And with English being the language that is spoken the world over, there is only one native English-speaking country left in Europe, and that is Ireland. So I've heard that the Central Bank of Ireland have staffed up for this, which is great news for the market in crypto assets, Mika or Micah, depending upon where you're coming from.
Yeah.
And wonderful. Let's really make this happen. This is a big, big opportunity for Ireland to get more crypto firms, crypto asset service providers, as we call them under Mika, established in Ireland, which is good for everybody in terms of, the foreign direct investment. And seeing that done in such a new, it's 14 years old, but I was going to say a new asset class like crypto is fascinating. So excited about that. We see things happening in Singapore. We see things happening in Hong Kong. The US is a mess right now, but at least they're moving things forward. I'd love to see, there's a Senator or Representative Patrick McHenry, who has really nailed this and figured it out. And he's kind of not letting anything get by him. But one of the things I learned from talking to Bradley Tusk all those years ago on Money Never Sleeps, he's a former political advisor turned venture capitalist, is that 99% of the politicians he ever met were out there for one reason: they're to get the next vote. It's vanity. And so you're going to have very nonsensical, illogical things happen in political circles for regulation for laws that should be getting through and being shaped appropriately and passed, that they'll be held up for political reasons. Hey, no, you can't pass that because you didn't pass this other thing that I wanted back 2 years ago, and it's quid pro quo. So there's so much of that in the US, which is really difficult to deal with and navigate, that it's taking a long time for things to come to the surface in terms of crypto regulation there. But we need it. We need it in the US. And I'm still a citizen of the USA as I am of Ireland. But over the next 3 to 5 years, like we talked about, I would love to see those spot crypto ETFs come to market, because I think that's going to drive a whole big wave of institutional capital into the space, which will be really helpful.
Yeah, and so the crypto assets, any other pockets like smart contracts that DeFi? I'm not going to put you on the spot.
And
the teams, right?
I mean,
you talked about protocolization.
I talked to a couple of folks who had gone to Token 2049 in Singapore, and they said some of the big things that were coming out of that, all the chatter was around DeFi, right? And the tokenization of real world assets.
Yes. Like
our friends at DeFactor. I know you had Alejandro on the show, where they are taking real world assets such as bonds, trade finance, receivables, and locking them into contracts and showing them as on-chain assets, and then enabling those to be used as collateral for borrowing. Okay. And that where you say get 40, 50% or whatever the percentage is of your collateral, you get that in liquidity. All right. And we're seeing that become a very, very interesting proposition to create liquidity in all these different pockets of asset classes and pockets of industry around the world. And again, very, very small scale right now, but it's a big, big, big opportunity. And Alejandro and I were on stage at a conference in London 2 years ago talking about this. There's 150 trillion worth of assets in the asset management market. There's another 250 or 300 trillion in the real estate market. There's another 200 trillion beyond that in other physical assets in the world. So something like 600 trillion. There's 1 trillion in crypto right now. So imagine where we would go even if we got 1% of that in.
Yes.
Okay. So there's
huge opportunity.
A big opportunity there. So DeFi, tokenization of real world assets, zero knowledge proofs. It's a very, very technical part of blockchains.
Infrastructure.
There's a blockchain, there's a founder that I've spoken with a couple of times, Alex Pruden from Aleo, A-L-E-O, and they are building their own zero knowledge proof blockchain. In a nutshell, what that means is that if I have a zero knowledge proof integrated into my crypto wallet, and I've got my identity card as a token in my wallet, I can authenticate myself and say that, yes, I am 18. I can buy this bottle of port. Thank you for that lovely bottle you gave me for my birthday, Jesus. All right. I can buy this bottle of port without actually disclosing what my birth date is, who I am, any other parts of my identity. It's just that, yes, I am 18, and you can prove something with zero knowledge. Okay. For blockchains to be used the world over, they are public ledgers. We need some more privacy around that. The default in anything we do in life is that we need privacy. Everybody privacy is the default. Okay. On a blockchain, privacy is not the default because it's all public. Although you may be anonymized, as soon as someone knows what your address is, they can totally see, because they can Google your wallet address and see what you hold.
Yes. Okay.
So we need, so lots of development around zero knowledge proofs or ZK proofs being kind of a big theme coming out of the, 10,000 people being together in Singapore in Web3 last month.
I love those themes, and Pete, we couldn't finish the pod without me asking you this, right? Because I'm very, very bullish on the convergence of technology, right? So one is, of course, DLT, distributed technology, blockchain, but AI, artificial intelligence, now coming together, right? What are your views there? I think it's a beautiful thing that's happening at the moment in the market, where these two are now really showing real value for solve problems like jointly. Right?
Absolutely. Yeah, I'd say it's, you have to be able to weed out the hype from all of this, right? And that, someone saying, hey, I was Web3, now I'm AI. Most of the time it's not genuine. So the people are very, very excited about the intersection of Web3 and AI, or blockchain and AI, or crypto and AI. And that there's a very small camp of folks in the world who really understand the value of this intersection, because it's incredibly complicated. Okay. So you take the example perhaps of training AI models to be able to have a intelligent conversation with you on the state of societal demographics and the split of, the split of different societies and how they contribute to economic growth around the world. And that naturally all of those models can have a certain degree of bias built into them. So can we actually authenticate what is being used in these learning models to be able to say, this is the source of the data for that? We can control all the source of the data for that. We can put the provenance around that. And see, even I'm stumbling over this explanation, okay? Because I don't truly get it. So that last 15, 20 seconds was me half jokingly trying to explain it, because even I don't get it.
No, Pete, I think you're right. There's some areas that, the intersection come back to, the smart contracts, and then putting the intelligent layer, on the smart contracts, be it provenance of the data, but also the incentives, locking in the incentives as well from a transparent way. Right. I think we're going to see a lot of innovation in that.
Oh, yeah. Well, you want to take the big future looking one. It's saying that, okay, if Web3 is a protocolization of web services, what could you protocolize? What could you turn into a protocol? In the 80s, you had email. In the 90s, you had documents that became web pages. In the 2000s, it became value. It became money with crypto. In 2010s, it became things like Arweave with permanent long-term data storage. All right. And so could you protocolize e-commerce? Could you create a blockchain protocol that anybody can just build on that enables you to provide an e-commerce type service as a code governed protocol on the web? Could you do that with social media? Absolutely. Could you do that with something like Shopify? Right? You could do all this. So as soon as things I hate saying that, as soon as they become protocols, but as this space develops and that as more and more web services that were provided by private or public companies on the internet, as those become protocols, that would AI then start to look and say, if I want to build a company, I want to do so with these 5, 6, 10 different protocols that I can combine together because they're composable, which is a big word at Web3. But how am I to know which are the right protocols to do that? AI can learn about all of this and could say, here are the protocols that need to be combined to be able to build this type of business. AI can go build that business and operate it as a decentralized autonomous organization. Okay. So, and govern the users and bring them all on board. So, we're like in neuromancer territory here with William Gibson.
I know, because if we would even blow it up a bit, the agents talking to the agents, right? The agents will call the co-pilot, companion, whatever we want to call it. And it becomes very exciting. But I think over the next 3 to 5 years, we're going to have some incredible use cases. So Pete, thanks again for coming on the pod. Thanks for staying a bit over. Really enjoyed the chat. Where can people find you? If there's anything that you want to as well, announce, because I know Techstars are having another big cohort coming soon, right? Where can the audience find you, and a bit about that program as well, if you want to share? Yeah,
absolutely. So applications are open right now for our 2024 class for Techstars Web3. You can find us on techstars.com/accelerators/Web3. Easy enough to remember. You can get me on Twitter at Pete Townsend NV. The NV stands for my first business I founded, Norio Ventures, not Envy Me, because I'm not Raps MVP. Okay, like the game.
You have to some bars, right?
I did. I had to get that in there. And obviously on LinkedIn as well. I try to look at LinkedIn Messenger as much as I can, but there's so much noise on that and it's hard to get to. So you can find me on LinkedIn as well. But the program will kick off on March 11th. We're hopefully going to be able to pick the top 1% of the applications we receive in order to get 12 companies. So you can guess how many applications that's going to be that we're striving for over the course of pretty much the next 8 weeks to be able to get all that in. So really looking forward to getting into our selection process in December and January and meeting a bunch of great founders.
Thanks again, Pete. That's the pod.
My pleasure. Thank you, Jesus. Love it.